Okay, very good morning. It is Tuesday, 1st of May. So welcome to a fresh new month, and looking at what we're going to cover in the briefing this morning. I'll go over a couple of headlines. We've had an update on the tariff front from the US administration overnight, decision that's been made there. Bit of movement from David Davis on the latest Brexit talks, in particular in regards to the border with Northern Ireland. We've had the RBA interest rate decision, couple of earnings updates, of which we'll have a look at Apple as well, which is due after market today, and then we'll have a little look at the day ahead. One thing though, first of all, just to be absolutely clear, is that most of Asia was closed overnight. The only real market that was open was Japan, so South Korea, Singapore, Hong Kong, China, all closed. And if you look at today's session, you already have noticed that no trade on the major Eurex products, the DAX for example, or the Bund. That's because France, Italy, Spain, Germany, Switzerland, so on and so forth, are all closed. So obviously you can trade the US futures products and the associated FX markets and oil market, but just be mindful then that there's going to be a lack of volume comparative to what we would used to see, or what we're used to seeing, I should say. Usually this means then that markets are relatively quiet when there's such a wide-scale market holiday. But one word of caution that I would say is that if you think about the liquidity in the market, if it's very low, and let's say there's a key technical level, for instance, that gets breached, quite often what you can see is quite sharp, short bouts of volatility, because there's not a lot of market depth there, given the market closures across much of mainland Europe in particular. So although things could be quite quiet, just be mindful of that. Looking at the headlines then, and then I'll hand you over to Sam, as per usual, who will look at the technicals a bit more closely. And this is one of the things that came out overnight. So we're awaiting the deadline, of course, for what the US were going to do with Europe in regard to the tariffs. And the US extends still tariffs relief for the EU and other allies. So just to give you the kind of summary here, what's happened: the administration has reached agreements in principle with the likes of Argentina, Australia and Brazil, but the details will be finalised shortly. The US, though, extended exemptions for the EU, Canada and Mexico for 30 days to allow for further talks. Now, I don't know, I think this is pretty much as to be expected. I'm not sure if you saw some posts I was doing last night, but the latest Rasmussen polls have Trump the most popular he's been in nearly a year at the moment. So, his fairly aggressive actions, or at least his rhetoric, seems to have got quite a few people on side, let's say, appeasing his voting electorate, and so therefore his popularity has increased. So has this paid dividend in that respect? And of course this comes in the longer play. It's got about 5 months, 6 months time when we get those midterms out of the US, but I kind of didn't really expect anything different here. Europe as a single market is too big an area and too important a trade partner to be playing these kind of games with. Obviously it's a bit of a different game with Argentina and Australia, for example, comparative to the entire Euro area. So this is a little bit of positive development, I'd say. It is, I guess, could be classified as kicking the can down the road, because it's going to be revisited again in 30 days. But the other thing, of course, is that Donald Trump's administration is due to land in China in the coming days. And so I think them backing off the pedal a little bit in terms of the kind of rhetoric on the trade war front, I think is to be expected. So I don't think this is having too much of a read across directly into the market. But I guess it's kind of a negative hurdle crossed for the time being. Other things are in the news this morning, and again, this isn't really having much in the way of ramification for pound movement, but we continue to see the Brexit situation, negotiations behind closed doors progressing, and this is the latest proposals that the UK, David Davis, has made on solution to Brexit deadlock over the contentious issue of the Irish border. Just reading the details, though, it doesn't really seem too much different from what they were talking about before. I don't really see how you could classify this as progression. But the situation here, just so we're all up to speed, is that the UK's preferred option, so they've got two, option A and B. Option A is to use sweeping new free trade agreement and customs deal with the EU to avoid the need for tariffs and goods checks at the border between the Republic and Northern Ireland. So obviously this would be the most kind of, calm response that would look to avoid any kind of breaking down of the Good Friday Agreement by enforcing a more harder physical checkpoint in that sense. If that cannot be agreed though, option A, then option B would use technological solutions and trusted trader schemes to minimise checks on goods at the border under the British plan. The two people familiar with the matter basically said the UK's new plan involved working on options A and B together in a move to break the deadlock for May in London as she seeks domestic support for her negotiating stance. So parts of option B could enhance option A is what's being talked about at the moment. But again, I just think that we've heard both of these solutions have been tabled before. Let's see. I mean, what was interesting yesterday, and I wasn't on the desk all day, but I did catch a comment from Michel Barnier where he was kind of, again, pushing, come on, let's get on with this. Quite interestingly, he was making these types of comments at a point where Theresa May is right under pressure, kind of, while her back's against a wall. It's kind of a good negotiating tactic from Europe. Let's put some pressure on May, while Amber Rudd, as you saw, was kind of the fourth senior cabinet official in the last 6 months to resign. So again, not really having too much of an influence on the pound this morning, but certainly these talks are due to recommence in the coming days, so worth keeping an eye on. The other thing again is in the news, but I think carries very little significance for intraday market prices, is Israel claims proof of secret Iran plans for nuclear weapons. I'd expect Israel to say absolutely nothing different to this. This is completely as expected. So although it's being run front page of the likes of Bloomberg and so on and so forth, this isn't a tradable headline, so to speak, because this is in fitting with what is and has been said before. Other thing overnight, you've had the RBA interest rate decision, so no surprises here. The governor, Philip Lowe, kept the cash rate on hold at 1.5% as largely expected, and as it has been since late 2016. So nothing really there either to get your teeth into too much. But one thing I'd say is keep an eye on the commodity markets. I guess if you are looking at the likes of the Aussie, gold is down about $7 at the moment. And WTI crude just marginally lower, still above pivot for the moment, but down about 10 cents. So if we get any further weight collectively in the commodity space, then maybe you get a bit of a read across into the Aussie, which is already trading below the low point of yesterday's range. Other things we've had, earnings season rolls on, and you've had BP this morning. The shares are up about 2%, so you'll see in my centre left chart I've replaced the DAX with the FTSE CFD. Obviously yesterday we saw the supermarket names in focus, with Sainsbury's shares up very sharply on the back of this tie-up potentially with Asda. Don't know if anyone caught the ITV News interview with the Sainsbury's CEO. If you haven't, please check that out online. It will probably make your day with how ridiculously complacent CEOs can be. But BP shares then are up positive this morning. BP, and I think understandably so given the resurgence of the oil price, profits at BP were up 71% in the first quarter. And of course driven by higher oil and gas prices and increased production as it undergoes an era of rapid growth at the moment. The other thing, of course, just talking about Sainsbury's and the supermarket names, we had Kantar, which basically collects the data that people and traders look at to ascertain grocery market share over a 12-week period. And these are the latest numbers that have come out this morning, so I just thought I'd recap it, because if you look at Sainsbury's and Asda, collectively you'd be looking at a market share of around 31.4%, which of course puts it above that of Tesco, which currently is by a clear distance the market leader, encapsulating over a quarter of the entire grocery market share at the moment. So the combined entities, the two second biggest players as Sainsbury's and Asda, would of course make that considerably larger than Tesco at the moment. What was quite interesting actually, while we're on the subject, I was just looking at this, and if I delete Morrison's and Co-op, and if we throw in Lidl and Aldi, because Lidl and Aldi have seen, quite spectacular gains. I mean, look at this crossover that we had a few years ago, where, due to the economic climate with consumers' belts being tightened, obviously the lower end of the market, Aldi and Lidl, have really outperformed. But what's been quite interesting of late, in recent months, is that the kind of majors, if you like, have started to come back to the disbenefit of the likes of the lower cost brands. One of the other things though we're looking out for later on this evening, in terms of the US corporate earnings, the big one of course we're looking out for today is Apple, but you're going to have to wait until after market before they come out. Chief Executive Tim Cook and other Apple executives have a major prove me period, is what analysts are saying, and this is because we are looking at how has the appetite been for the highest priced smartphone we've ever seen in the iPhone 10. What's really interesting with Apple, and this is very common for the firm to do, is the company has been in conference calls with Wall Street analysts over the last 2 weeks. And this is very classic management, I think, of massaging market expectations. Because what's happened over the past 2 weeks is that analysts on Wall Street have been cutting their iPhone sales estimates, and Apple shares have been down almost 8% over that period. So what tends to happen is, if you lower the bar of expectation heading into your earnings release, knowing that you've got maybe not that impressive numbers to deliver on things like your flagship product, it means that when it comes in, then you've already kind of prepped the scene, and the market typically responds positively because then you've outperformed these beaten down expectations. Apple, notorious for doing this. And seemingly the same thing has been happening again. Key things that we're looking out for then are recent concerns about Apple's iPhone business have been fanned by suppliers that have reported weak demand for the high-end handsets. It's also under pressure in China, where some consumers are shunning the pricier iPhone for more local rivals whose technology obviously has been improving quite rapidly. Just moving further down into this article, a couple of key metrics here to look out for. Let's not detract from the point though that analysts are looking for Apple to post revenues of $61 billion for the fiscal second quarter. So again, their earnings reporting period slightly different. They're reporting Q2. Or 15% year-on-year growth they're looking at. So these are phenomenal numbers. The only thing is, we're used to phenomenal growth from firms. This is why those FANG names, which are highly invested, if you think about someone like Google, for example, which puts a hell of a lot of investment into R&D and development of new revenue potential streams, it means then that their multiples of earnings potentials are way higher, because they're looking to diversify into what could be the next biggest ticket to produce large revenue streams. The only thing is, none of that actually exists as yet. It's a hypothetical, but it does mean that these overpriced nature of these stocks can see some quite big pullbacks from time to time if it doesn't live up to the hype. The other key thing here then is, obviously Apple can afford to have slightly weaker iPhone sales, particularly in the high-end models, because their ASP, their average selling price, obviously is substantially higher. So their margins are improved by the fact that the handset is so much more expensive. A few things, though, that other people are looking at is that, well, in effect, despite the fact that the iPhone generates about 2/3 of the sales for the company, is that service revenues have been consistently picking up. So again, this is the kind of quest for diversification, is trying to generate more income out of things like apps, for example, and monetizing that area, as well as other products. I think AirPods as well. I've been absolutely surprised by how popular AirPods have been. I see people on the tube, nearly everyone's got them. I'll leave my judgment as to what I think they look like from a fashion point of view. Yeah, this is what's happening elsewhere, and certainly a revenue service figure is worth watching later on this evening. One other thing as well I thought I'd point out, people as old as Will and Pierce will remember the saying of sell in May and go away. That's quite a classic, infamous saying in the market. But actually, the statistics suggest that before we get carried away with that saying, the S&P 500 has been higher in May each of the past 5 years. And so just got a little infographic here looking at history. It shows that US assets outperform in May to September period. So the average return for that, you can see in terms of the S&P 500, is kind of around 1.1, 1.2%. So that seasonal kind of saying is being less and less true over time. Okay, quick look at the calendar for today. As we come in towards the morning period, we're looking at 9:30, and that's going to be quite critical for the beginning of the PMI suite of data, which could be the final nail in the coffin for the hopes of a May interest rate hike from the Bank of England. Today is manufacturing, we'll get construction tomorrow, and we'll get services, arguably the most important one, on Thursday. But just check out this graphic here, which is the rise and fall of expectations behind a Bank of England interest rate hike. So at the beginning of April, so this time, the 1st of April, we were priced at almost 100% for an interest rate hike from the Bank of England. But as we know, a weaker than expected GDP print, a faster falling inflation rate than was anticipated, these other factors that have been in play have resulted in, not to mention a dovish Mark Carney, the unreliable boyfriend as ever, has meant that these expectations have collapsed over the last 15 days. We've gone from basically 90% to sub 20%. And if this figure is going to go down to, what really would be towards zero or very low probability, then it kind of hinges on the performance of these PMI numbers. If they come out weaker than expected, then I think you can write off the prospects of an interest rate hike on the 10th of May. If they come in stronger, this will likelihood rise back towards, I would imagine, depending on how strong the data, more like a 30-35% region. So I'd say on the balance, maybe people still will be sitting on the side of no hike. But the Bank of England have not exactly done a very good job if their ambition was price stability, if the market is fairly even balanced on their expectations. Because when the market's priced 50-50, it means you get quite sharp bouts of volatility that ensue, because we really don't know what the situation is going to be. It's a toss-up of which, if that data is strong this week, it could well be. All right, let me hand you over to Sam then. He can look at the charts more technically, but I'll see you in the chat room. Overall, the main kind of bottom line is all the headlines we've talked about, nothing's really outright, I'd say, something to set the sentiment. And remember, France, Italy, Spain, Germany, as well as other countries are all on holiday. German markets are closed, as to all those other countries. Most of Asia was closed. So do keep that in mind. All right, have a good day.
Yeah, just following on from that, I think obviously important to be realistic with profit expectations, and also yesterday you had what overall was a session until maybe literally 4:30 was very quiet. I wouldn't expect too much from this morning. Let's have a quick look through the currencies. You can see euro just having a little bounce from what was the low that we had last week, the first test, as you would expect to be the strongest. In terms of levels to the upside to be aware of, you've obviously got the low of the morning that we did break through. You see here, let me just sort that out there. You can see broke through, haven't really come back to test it, so that's an area I'd be aware of. I think from the highs that we had yesterday, you've got a bit of a trend that's kind of been respected as well, so that's something I'll just bear in mind. If we do get a break of this downtrend over the last sort of 24 hours and a bit, just be aware of the speed of that push higher. But I think you've got to favour the downside to this market still. It might be that you prefer to wait for the pivot instead rather than the previous low of the day. But I wouldn't be going chasing these markets. I think the volume is going to be considerably lower, similar to yesterday in what to expect. Bigger things to come later in the week. If we have a look over at the pound, the pivot held quite well along with this trend that we put in the chat earlier, so just keep an eye on that. If we can get a push lower, then through the low of the day, which has actually been quite good support late last session at 5 o'clock, we get a breakthrough there, then yeah, S1 and any size low could come into play, but again, wouldn't really be chasing the market. When the profit's on the table, I'd be looking to sort of de-risk ahead of that. But directional bias, again, same as the euro against the dollar, really favouring the downside here. I think there's still a bit more to come for this pair. Maybe not necessarily today, but I'd still expect, if you ask me now, I reckon we can get another test of that low, whether it be a previous push higher to then come back down again. But I think we can get a break of that trend, and S1 in yesterday's low is not a million miles away. For Aussie dollar, you can see the main sort of push really happened into the back end. Like I said, 4:30 it started to get a bit more interesting. So patience, probably the best way to go again here. We've had a push down and through the low of yesterday, so not the worst sort of trade idea to be in for that now. But to pivot, yesterday's sort of highs in the afternoon, not a bad area to think about as well, but again favouring the downside here. In terms of targets to be aware of, I'd be looking at S1 to hold up quite well. You can see if we take the lows from the previous days, marks up pretty well around that area. So looking for the dollar to strengthen. We're just pretty much near the high of the day for the dollar itself. So just see if we can get a continuation here, but not chasing the market, not being too aggressive. Taking the profit when it is there would be my advice. Dollar yen, as mentioned, the dollar had been on those highs, and you can see this market as well suggesting that R1 first test holding quite well. And you've got this market, I mean, it looks like it's in this bit of consolidation really. It's been out of the dollar pairs that we focus on here, I'd say the hardest one to trade over the last sort of 5 or so trading days. I'd look for a confirmed break really above that R1 and the high from last week, although maybe the volume won't necessarily be there today. I think if we come back to the pivot, while the pivot has, if we take the area of the pivot over the last few trading days, it's a complete mess. Marks up relatively okay perhaps later on in the day with this trend line from Monday's afternoon's low and Friday's low. And you've probably got the low there of the 24th coming into play. Not a bad area. S1 in yesterday's sort of low point as well, not bad technically. Don't necessarily think we'll get down there on a day like today, but something just to bear in mind. So favouring a push above the highs, or a pullback to look to continue this trend of the last few weeks really of dollar yen, which has, as you can see, been pushing higher since late March. So looking to continue that really. Oil, we saw the push higher late last night, and we got to within a few ticks of the high that we had there on the 24th. Let's bring this chart out. So not quite the yearly high that we had. I'd still be keeping an eye on those levels. You never know with oil, it can get there relatively quickly. Pivot technically looks quite interesting. You had the high of Friday here, you had the lows that we made last night, and obviously the technical mathematical pivot level. Not the worst sort of trade in the world to look at that as an area of support, especially on the first test. In terms of profit expectations early morning though, I wouldn't be expecting us to get to say the high of the day anytime soon. So again, a case of sort of being realistic with oil there. Just one to bear in mind though, with oil at the moment, you've got gasoline just pushing to a new low, so that could have a sort of that impact. Bit of support coming up here in gasoline, which was the high of the day, then the classic off the pivot yesterday. So first test of that, you're finding a bit of support there. If that holds, then it will help obviously oil perhaps hold out there. Looking at the Canadian dollar as well, so with oil under pressure, you're getting the Canadian dollar under pressure, a bit of support coming up. So interesting time for oil, gasoline and the Canadian dollar. We'll just be keeping an eye on all these levels coming to a bit of support now. So it could be the turning point, or it could be where actually you get the breakthrough, and so on. In terms of the Canadian dollar, in terms of the trend that we've been on, again you're getting that sort of dollar yen consolidation period where in fact the range trade looks a bit better to get involved in, rather than the levels that we are at right now. Quiet market, so even in the afternoon necessarily the equities won't be at their strongest volume, but S&P here, the pivot with the low that we had on Friday marks up quite nicely. You've got the low of the 26th, which is also the high of the 25th in the morning, for sort of determining that range that perhaps that we're in. We wouldn't be chasing again this market in the morning, perhaps just waiting for it to sort of come to a better area than before. You can see again, mentioned that sort of after 4:30, that's when this market really started to pick up, and it'll be the same for the Nasdaq and the Dow. So just waiting to play the range. Overall direction, I mentioned in the briefing yesterday, I'm not really sure. It's in this period of just going sideways with some big up days, some big down days, and then it's hard to pick an overall direction for this market at the moment. The correlations of bonds and equities going the same direction, and then the opposite direction, it's changing on a daily basis. So it's a tricky market, not necessarily the one that I would be focusing too much on at the moment. Gold, with that dollar strength, nearly testing the low of yesterday. We had the brief push higher yesterday into sort of the back end of the session with equities coming under pressure. That since has been paired, and we're near the low of yesterday again. So that's a multi-week low. Keeping an eye on that break of that, and then S1 will come into play, you'd imagine, quite quickly. In terms of looking for perhaps a pullback, the area I like the look of, other than the pivot, would be this point in the market here. We had good support on yesterday evening just before the close, broke through early hours and haven't really come back to test it. 13.15.2 would be a point in the market I'd be looking at there potentially later on. Any questions, as usual, please do get them in the chat. We're seeing the dollar just come off the better levels. Equities the lowest they've been for the last couple of hours, but nothing really happening too much. I'd also keep an eye on oil around these levels. If we get a bit of support in those levels mentioned in gasoline and Canadian dollar, we could start to push a bit higher from here.